Hey, good morning, all. So this one's just a subscriber stream. Obviously, I've been offline for quite some time, but I just wanted to touch on a couple of things, right? So I know some of you newer guys might not have picked up on, I guess, the kind of ins and outs, but I think you've really got to spend that time to go through the educational content, right? Especially you guys that have bought the lifetime subscription, right? You've got plenty of time to kind of take this on board, right? I guess the biggest challenge of all, many people come, to us, and they come onto the server, and they're either wanting signals, right? And it's like, where are we going now? What are we doing now? What can I look at now? I guess when you first start trading, right, it becomes almost exciting, right? And I know Paul calls this gamification. I guess the general idea is that you assume, a 15-minute chart, an hour chart, it's the best way to make money because there's always an opportunity. But the reality is, these opportunities become an awful lot harder to spot without the larger scale bias, right? So as time goes on, your account grows, you get more and more confident in this. What you'll find is that you'll start to disregard indicators. You'll start to heighten in terms of the time frames. You'll start to reduce the noise. You know, you'll almost take a step back, and what you'll see is kind of steady growth, longer term, right? I think when you're trying to play the game to begin with, this is where I guess the excitement comes in. The thrill is there, obviously. However, the opportunities that you deem to be an opportunity are very likely to be the opportunities for a loss, right? So, what I'm going to do in this one is just kind of cover some of the obvious, right? So a lot of times I see people send, charts and screenshots, and they come to me with questions, and it's normally filled with 15 different indicators. It's normally inclusive of things like an RSI, a moving average, MACD. And I just want to explain why all of these things are shit, right? If you're going to still use these things, you're almost asking for trouble, right? These are the retail indicators. A lot of the exchanges, brokers, you know, companies that are trying to get you to lose your money. These are the things that they give you for free, right? Now, I know TradingView's got an awful lot of indicators kind of there, but these things are all lagging, right? And they make no sense at all. So let me just cover these kind of really quick, and I'll go into kind of the order blocks and some other bits and pieces as to what you can kind of already see, right? And I want to show you this because there's a couple of things, and I think in the educational section, come down to the education, I think it's in the interesting lessons, right at the very top, the very first one. I think it is in this one. Yeah, just have a click on this, right? This is one of the first. So the interesting lessons in the education section, right? This is one of the best ones in terms of showing how you can read what the charts are telling you without having to have all these indicators, right? This one is actually showing how not to need volume profiles, for example. So what you got to look at when you're looking at things like moving averages, I got a 200 in blue, and I think it's a 50 in red. I've got the standard RSI and the standard MACD. Now I know there's lots of other indicators and so on and so on. But what you got to look at, right, is people say to me, oh, well, when this cross happens, if you take these crosses, there's a cross, kind of come in there, there's another cross there, there's another cross there, there's another cross there. These are all trades where you think, are they long enough trades for you to buy and sell? Are they accurate enough? And when you run back testing on these, the reality is no is the answer, right? They work sometimes and they work some of the time. Right? If you look at this one, great example. Crossover, you think, oh, well, we're now moving over the moving average, great opportunity for a long. Right? Look at where the cross actually happened. Crosses you. Right? So you've missed the impulsiveness of the move. At this particular point, if you're looking at an RSI and you get your crossover on you, you're already in the overbought territory, which means you've probably disregarded this long because you've got a conflict of interest with the indicators. So this is why it's just noise, right? It's just kind of background noise. It's not really worth anything in the grand scheme of things. RSI, right, is predominantly used in a trending market. Since COVID, right, we've more or less had a sideways moving market, right? We've come down to a kind of a 0 point. We've had almost zero impulsiveness all the way through, right? So I think for me, in the grand scheme of things, if you're using again the wrong indicator at the wrong time, for maybe even the wrong chart or the wrong instrument, then again you're kind of asking for trouble. So look, I just wanted to kind of highlight some of these things, right? Because although I've said it and I've said it and I've said it again, it's just emphasizing that, when you get a conflict of interest, for example, you're using the wrong indicator, you're using the wrong type of indicator for the wrong type of move on the chart or the wrong type of situation on the chart. 2 seconds. Then ultimately, what you're actually seeing is, you're almost causing yourself problems, right? So the reason that you need to strip things back and the reason that you need to kind of dumb it down a little bit is that the market is only ever seeking liquidity, right? So for me personally, when I look at something like Elliott Wave, I'm not looking at every single swing. I don't want to try to assess or analyze, whether this is a flat or an expanded flat or whether this is an A or B or an X or a Z. What I'm actually looking for is just a bigger term bias, right? It's, are we going up or are we going down? But that's the major factor I'm looking for, right? So the next thing is then when you start having a bias, right? And this is where, like I said, for me the Elliott comes in. What you have by mixing these indicators is conflict, right? And this example, perfect scenario, right, of that, confused message. Now, if obviously these indicators were so good, standalone, everybody would actually be using them, yeah? If you look at what we've actually got, right, on this RSI from this latest move, it's only telling you what the price has actually already told you. We've had a crossover here. We got a short coming. You would have seen this long, right, and bailed out because you were on a 15-minute chart. So you wouldn't have taken that short anyway. The same thing with the MACD. You're looking at every single swing, every single move, every single piece. It's only giving you data. It's like, oh, look, price has rallied up. Oh, price has rallied up, right? These are the problems that as new traders you're going to face, right? So when I look at things like order blocks, when I look at things Wyckoff, Elliott Wave, I'm not trying to read too much into them, right? I get questions like, how do you know when this is a spring? How do you know when this is an STB? You don't, right? Wyckoff had one major rule himself personally, right? Now, I know Wyckoff is a bit of a strange one in the grand scheme of things. Wyckoff has basically a group of followers that ultimately are students that ultimately picked up kind of where he left off and kind of added a few twists and a few different things to his kind of trading style and methods and so on. Right? So let me just give you kind of a rough idea, right? When you look for something in Wyckoff terms, you got to look at, one of two things. First of all, have we come in to a range from above or from below, right? Now, obviously, depending on one of these two factors, right, will depend on what type of schematic you start to look for, right? Now, this is where the Elliott wave comes in. If you're seeing a 1, 2, 3, something like this, 4, 5, we've got distribution, distribution, accumulation, 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 distribution. So you can kind of look for what type of pattern to expect in Wyckoff terms, right? Now, although this is relatively advanced in a way, this is where the master patterns come in, right? So the master patterns are basically dumbed down versions, right? When I look at a Wyckoff schematic and I look at, say we're coming in from below, and we come up to a buyer's climax, and then we ultimately come down for the first AR. We come back up and we test, this range or even slightly higher, right? Then ultimately we come back down for our first test. Now, whether or not we go in, up or down, right, depending on, distribution or redistribution, accumulation or reaccumulation. The reality is what we're creating is this sideways consolidation. Then you have a center line. Now, this is why when you look at a master pattern, this is roughly what they're drawn as. And what you tend to see is as these moves play themselves out, right? So we come up, maybe we see a UT followed by a UTAD. Right? What you then tend to see is a move, in essence, that looks something like this. If you measure this point and this point, they ultimately become more or less the same, right? 9 times out of 10. Now, truth of the matter is, right, you can add your point and figures, you can add all these different things to the analysis, but in essence, it's this is what you see, right? The reason I wanted to share this and the reason I want to show this is that when you can see what a consolidation is doing, right, this leads into other factors, smaller time frame. So breaking it down kind of step by step by step is that I'm looking for an Elliott bias, right? Something like this, and I'm saying, oh, okay, right now, this 3 ticks off my 1618. We've hit a rough range. Right? Now I can start to assess what do we see in smaller time frames inside that range, because we're going to be distributing in there for a 4 to come down to move up for a 5. Right? So this move here, right, is no longer this one. It's now more likely to do something like this. Right? So what I'm looking for, first of all, is bias. Then I'm looking for the range, the consolidation range. That volume will start to contract, the price will start to contract, right? And as we get this, you can start to define where we are, why. Right? Going back to the start of when I started painting this in terms of Wyckoff, what Wyckoff himself did was not stress about the price coming up and doing this inside, right? He didn't stress about a spring for a move up. What he was actually looking for is the retest of this zone, right, after the move away. If the price was different and we come down, drop through, he was looking for this extra confirmation, right? Which is basically saying, I don't care too much about what happens in you. Right? I'm not looking for a spring. I'm not looking to buy, the bottoms and sell the tops. What I'm actually looking for is this doing what it should do? Do I get my confirmation on the exit? And am I comfortable with my bias that this is the direction that the price wants to go? If you can master that aspect of this, right, you've nailed trading, right? There's no other way to explain this, right? You've nailed it, right? Now, when you look at things like Wyckoff, right? Wyckoff is a very difficult technical technique overall. What you start looking at from how the price contracts and how the price actually kind of groups together, you'll see volume profiles, and the video I just shared in the interest in essence, this one here, right? When you see how you can assume volume, right, you can quickly break down, what's happening, right? So for me, take this as an example. Price moves up, right? Got an area or range here where the price didn't come back to revisit. Well, there's going to be liquidity sat in there, right? There is clear an area of interest in and around this because the price went sideways. So again, liquidity in this, right? So if I had to draw a box right now, where do I think liquidity is going to be sat? Right? There's going to be interest in this range, right? Then we come up, we have the very last sell before you buy, and the price skyrockets, right? So all of this now is deemed technically as an imbalance, right? Now, all of this range gives me another area of interest, right? So I'm just going to draw the center line, right? So there's an area of interest almost straight away, right? No indicators, no idea what's happening on the chart. but in essence, these are the kind of things that I'm looking for. Right? When I start to take this with my bias, I can start to say, well, what am I expecting overall? The price has gone sideways, right? So I'm creating this master pattern block, which in essence is some kind of Wyckoff as a move. We've had a nice markup or a nice move up, which means without knowing too much context to the story, I'm more likely to say this is some kind of distribution. First level of distribution, probably down to the center line. I'd like to come back to the underside and test the underside of my range. And where would I like this to come down as a markdown? Well, where's the liquidity sitting, right? So if you take this as an example, right, this is exactly why indicators don't really mean that much, right? I'm not even using a stochastic on this particular example. If you can start to see these things this clear, right? You've nailed it, right? You've mastered trading, right? And honestly, it's as simple as this, right? If you can see these lines and these levels, and a lot of these things are, visible from miles and miles and miles away, right? So I know you guys, know in terms of what I've painted, what Paul talks about in these streams and so on. But obviously, as members and the subscribers, you got a lot more insight than what we share with just the general public, right? In terms of these key levels, right, this works, on kind of any time frame, right? So yesterday's stream, let's use this as a great example. Yesterday's stream, right, for the public, I basically talked about, what I've said for the last 18 months, 2 years. Biggest question marks for me still remain, right, as to whether or not this is the cycle. Maybe the only thing I'm slightly confused on, right? And I guess this is not an issue because the bias time frame is so large in either scenario. Is that if we assume, a 1, a 2 move, right, or whether this is the 2, whether this was a 3, a 4, and a 5, right? The first real question, right, is if we assume that that 5 is a larger scale 1, then we're obviously coming down for a 2, right? I quite like still, right, the fact that although this would invalidate it from a pure Elliott perspective, right, there's still a scenario where this 3, 4, 5 is only creating a 3 of a larger degree, right? Now, I'm not going to go into all the detail of that, right? It's just, something that I've shared a while back, right? Now, personally, I kind of still like this. There's something telling me in terms of a gut feeling that the fact that we've come down, we've kind of invalidated from a pure Elliott perspective, but it is Bitcoin, right? There is a lot of other people in the market that are, not respecting these levels. But I think Composite Man is playing a game, right? So we got this kind of consolidation sideways. I kind of like it as a 4. The reason I like it as a 4, I do think we could pop up for a 5, right? I do like the idea of that being a triple top. That gives us a 5. Right? We then come back down ultimately for a deep move. Now, again, deep move wise, right? We could be seeing a fair value somewhere in this range. Right? Let's just say 40k. I know 36k was used for a while, 40k, right? If we go back up to 60, 65, and then ultimately we come back down, I'd be quite happy with a larger scale 2 sitting there, right? Because at this point, this 1 would be, right? So this would then be a quick sell-off, and I would say a very fast move, although it's such a big time frame. So I like this as a scenario. Obviously, the prime scenario at the moment is probably the fact that the 1, 2, 3, 4, 5 that I've had marked up, so something like this, right, is giving us a deep 2 where we are right now. Right? But again, it's kind of irrelevant, especially on these larger time frames. And the reason that it's irrelevant is that any which way, my bias is to the upside. I'm looking at this as a level of accumulation. Whether or not I'm at a 3 or a 4, I want to see, this move up for a 3 or this move up for a 5, right? So I kind of don't care in either scenario. And this is how I use Elliot, right? Now, when I'm looking at these kind of key levels, these next kind of plays, whether it's obviously order blocks, whether it's buy before you sells, whether it's auction areas, master patterns, whatever you want to call these things, right? You can clearly see we're going to have liquidity sat up above this level, right? We're going to have ultimately imbalance levels there, right? But there's also this here, right? Which is another area, click this, another area of interest, right? So you're creating this kind of range. So if we tap into this range, right, there's nothing stopping us then coming straight back down, to this kind of level all over again. Right? We've got the liquidity on the smaller doses. We've got imbalance, imbalance, imbalance sitting in there. We've obviously got an imbalance sitting there to the upside. So the bias now becomes, what are we likely to see? Why? Now, I quite like a distribution from this on a smaller time frame. So I'd like to see a test of this level. Nothing stopping us popping into that range. That could give us a UTAD and down if we haven't had it. But in the grand scheme of things, the bit that I'm now interested in is where that liquidity is set. I feel comfortable, confident that we are in a larger scale accumulation, right? I feel that at the moment the market is not trending, hence no need for an RSI or a MACD. I don't care where the moving average 200 sits, because the moving average 200 right now is down, because for the last 200 days it's technically been down, right? I think in the grand scheme of things, this is how you need to treat looking at the charts. Look for the areas of interest. Look in terms of the bias. Use your master pattern Wyckoff. If you really want to go down smaller time frames, then you can start to assess that, Wyckoff's now. If you really want to play with Elliott Wave on a, it's a this counter trend trade move, if it's this level of correction at this particular wave, then, crack on, it's good practice. Would you trade it? You shouldn't really. Would I trade it? Definitely not. But I guess in the grand scheme of things, if it's exciting to you and you want to look at it, then be my guest, just be careful. And I guess if you're looking to do this, professionally, you're looking to do this kind of properly, then there's no harm in taking a step back, right? I shared, I think, in the visitor section a while ago, a few quotes from a few different people. And I think the message for me is pretty much the same all the way through. If you're looking at, trading professionally, 90% of the time you're sat on your hands. And I know that becomes boring, but that's where the money is really made. So anyway, I'm going to leave it like that, right? I know this one's a longer one, but it's kind of making up for obviously lost time in terms of the month that I've had without the internet. So anyway, hope you enjoyed it. Any questions, feel free to fire them back. I'll see you soon. Cheers, guys.